Hello, Sense of Things. It's Jeff here and Ron, and we're kicking off another weekly update on what's going on in the world, what's going on in the economy, and what's going on in some goofy little thing that we'll probably talk about here at the beginning. Ron, how are you doing, buddy?
Not too bad. Not crazy with the heat, but I heard July 3rd, and I think yesterday may have topped it. Hottest day on Earth in history.
Wow.
I don't know how it was by you. It was hot here, but it was manageable. But no such thing as global warming, right? Although it's called climate change today, but no such thing.
We had the hottest, I think it was on record, the hottest heat index day. It was 118 degrees, but I think 2 weeks ago.
Wow.
So pretty much anything over 100 is just unbearably hot. So it doesn't really matter. We're actually below 100 now.
Bad too.
I almost had to put a jacket on this morning because it was 80 degrees when I got out of bed, got outside.
I hear you. Turn off that AC.
Oh, I know. Yes. Yeah.
I hear you. Now, listen, the summer is just getting started, right? We got at least another 60 days to go until Labor Day, and a lot of interesting things in the market. There's no summer slowdown. Rather ironically, despite the pullback in the market today and the other international markets not liking the Fed outlook and all the other good stuff.
Yeah.
Even with all that, I thought a couple of things that were pretty interesting were that July seasonally is typically one of the best months of the year.
Interesting.
And even coming off a terrific first half, best first half in 40 years, even though it was only 8 stocks, July is still seasonally one of the best months of the year. So it should be interesting to see, did we have a blow off top last week at the end of the quarter, end of the half? Or are we just getting a nice little pullback to continue on the rally here? Although I think you and I both agree it'll probably come to a head here by September, October, but July is seasonally pretty good.
And I think too, it's people are tending to be a little bit away from the market. So you don't have as much volume on the markets. I'm watching it across some of the stocks that I follow, and you can just see volume just been dipping off over the last few weeks. Those moves in the stocks can be magnified too by what's going on.
I know also with lower volume, the stock prices are going to get pushed around. I'm just quite surprised that with those top 8 stocks in the S&P, with as much of a move, and last week was an absurd move, parabolic move.
Yeah.
Where's the profit taking in those stocks? People are going to go away on winter vacations. You would figure, oh, let me harvest off some profits, take a little bit off the top here. Didn't really happen as much, which is a very interesting. I
think it's an interesting play. I think there's so much interest in artificial intelligence and all that, and they're trying to. It's interesting to me to watch how the market is it's almost like they'll just build in some kind of artificial intelligence thing into every company, even though it's going to be a minuscule part of profits. But they're using artificial intelligence, and most people don't even understand what artificial intelligence is and, how it's being used. It's been around for years.
Decades.
Nothing new that a lot of these companies have been doing. If you want to talk artificial intelligence, why is IBM just languishing along? I mean, with Watson, they've been doing this for the last 20 years.
Yeah. I think what's interesting with the AI, and I know we talked about it, AI started back in the 70s and the 80s, and there wasn't the computing power. I know that's one of the reasons, but if I could look at AI, we're only still in the first inning.
Oh, God, yes.
Maybe second inning. I think AI is really where EV was 10 years ago, where the internet was 30 years ago. Yeah. It'll be something someday, I think we all agree, but there's just so much fluff in these stock prices because until it truly becomes commercialized and monetized, it's going to take a long time.
But so much of AI is not going to be like the direct ChatGPT type products and stuff like that. It's just going to be merged into a lot of what companies do. And it's akin to the productivity curve, I think, that happened early or mid 90s through, let's call it 2001, 2002. You had that massive productivity increase because you think about it prior to that. When I started in business, there was still it was at the end of, you had a secretarial pool and you gave your stuff to a secretary and they typed it in or whatever. Now we do all that. We type in, I'm faster probably typing than half of the people that work for me over the years.
About 15 years ago, quick funny story. About 15 years ago, I remember having an appointment with somebody, and he was definitely a veteran, and he got out of the corporate world for being in there 35 years, and he always had a love for coffee. So he was importing beans from all over the world and packaging and selling them in the US. And he was very old school, and I'm being very generous with that phrase. And I remember him saying, well, I got frustrated with my computers, didn't call it software, but my computers. Every time I need a report, I got to call down the data processing. I mean, data processing.
What the hell?
What do you got those, the cathode ray tubes that are out of the top and you got to replace them?
Yeah, that
the old UNIVAC system, the ENIAC system, from the University of Penn.
Yeah, the card things, they put the big stacks of cards in and
oh God. I got to call down the data processing. That was only like 15 years ago. That was the last time I heard something like that. But yeah, the technology is going to evolve. But I think that there's 10 to 15% minimum in a lot of these top tech stocks that are just what I'm going to call hype fluff in that price. And the air will come out at some point, but people will stay in the big boys until AI truly becomes something. We'll have to see where it goes.
But we're seeing a little bit of breath coming into the market. It just seems like the money's not coming out of the big ones. What you would think is, okay, people start to take profits and then they shift, because money is not created or destroyed. It just moves to different places. And we're seeing some breath expand in the market a little bit, which is good. But you're still seeing those 8 to 9 stocks that are just running the table at this point. And I just don't know when it's going to stop.
You know what? Look, I'm on record. I really thought we'd be 500 points less on the S&P by the end of June.
Sure.
But that was immediate term. I think my long-term thesis is still intact. My short-term thesis, rather ironically, the target that I had for the end of June actually was hit in March with the banking crisis. Okay. And then it bounced from there, and we know where it is now. I got some charts I think you and I could probably go through.
Go ahead and share those, and then
that I think would be helpful, because I think this is just going to reiterate a lot of the things that we've been talking about. One of the interesting things about this, if you go back looking at the S&P 500 12-month price earnings ratio compared to the real 10-year yield. The real 10-year yield has always been the leader. When the S&P has always followed it. You could see when it went down, S&P went down. When it went up, the treasury yield is the 10 years always been called the North Star.
Yeah.
Then all of a sudden in 2022, with the rise of inflation, it diverged. And if you notice from the beginning of 2023, with people thought obviously a lot of the tech stocks were at a low, AI all of a sudden became to the forefront versus the background. It took off, while the real rates basically languished. Yeah. So one of these is going to win, and I think you and I know which is going to win, because the bond market is the smarter market. It always has been. It's a much larger market than the equity market, but we've spoken about. And typically the bond market is 6 to 9 months or more ahead of the stock market. Yeah. And a couple of other interesting things here, and I know this is a little bit of a busy chart, but if you just take a look at the liquidity in the market compared to the S&P, the liquidity has pulled back. It's gone down while the market has gone up. So you can't tell me that that's just not fluff. Yeah. This comes from the St. Louis Fed, our friends over there that always produce these wonderful economic charts. And then just drilling down a little bit more, I know we've showed similar charts of this. I have 2 charts. It's the 10 and the 2-year, and it's the 10-year and the 3-month. So we've talked about this several times, where you can see, and I know we've done this chart a few times, where you can just see every time we've had a divergent or negative rates with the 2-year going below the 10-year, or I'm sorry, the 10-year going below the 2-year, a recession has followed. We hit -1 divergent with the 10-year and the 2-year. If this isn't like a steepening, not only a steepening of the curve, but also the banks are tightening credit, so less money is going into the market for borrowing. We have the issues with commercial property. I think I just saw some stat, don't hold me to this, that Manhattan, New York City is like at a 30, 40 or 50-year all-time high in vacancies in office space. It's insane. And of course, the chart that was one of the Fed's favorite chart is the divergent with the 3-month over the 10-year. This goes back over 40 years.
Yeah.
Look how low we are.
Yeah.
The Fed, and again, I know we talked about this in our pregame, the Fed is telling you and telegraphing what's happening. They haven't lied. They can't tell you, is this the last rate hike or when do you look? They're not going to tell you that. What they did say is rates are going to stay high for a long time. And they've been saying this for 6 months to 6 to 9 months. Why would people doubt them? Now actually the Fed futures have now priced out a potential rate drop, a pullback before the end of the year, which you and I were just laughing at over the last month.
It's like, okay, they're never going to do that. They're never going to go from, okay, extremely tight. Okay, now we're going to loosen. They're going to let it set for a while and see how it all starts to affect. And then they always react later in response. They don't preemptively do this. And why would you think in less than 6 months, they're going to change their minds drastically at this point?
No, they're always behind the curve. We know that. But even back in May, I know I said it, I believe you echoed it, when people were talking about, oh, they're done. No, I said, we were talking.
No way.
There's probably going to be 1 to 2 more rate hikes. And all they did after they said they paused in June, or they don't want to call it a pivot, all that language, they still said 1 to 2 more. We were correct in that assumption in May. And they said, and people are now saying at least 1 to 2 more. Why would you doubt their word if data isn't drastically changing?
Yeah, it's starting to, I can see it's starting to have some effects, but we're still over 4% inflation. And I think this is going to be the stubborn point. It was relatively easy, surprisingly, to get it from 9 down to 4. But it's like losing weight. You lose a whole bunch at the beginning, and then there's that point where you plateau out and it just doesn't go any farther, and you've got to work harder and harder. You've got to do more damage to get it to go farther down.
That and that big bowl of ice cream late at night and that Reese's peanut butter cup on top doesn't help either.
That can do it. And we keep chowing down on the bowl of ice cream. Every time the Fed says no, we sneak in, the government sneaks in overnight and grabs a big old carton of ice cream and just starts chowing down on it again. I think there's just that constant back and forth, but I see this is good enough time to talk a little bit about the student loan thing. That failed, or it was struck down by the Supreme Court last week. All right, so that says there's really no relief for a lot of those borrowers out there. And August, they have to start paying again. And they have not paid for going on 3 years now.
Yeah.
I think you were saying a stat that was somewhat shocking to me.
18%?
Yeah.
Yeah, 18% of the people that have student loans haven't paid a dime since the moratorium went in place. I don't know, what was it, March or April of 2020?
Yeah.
And I'm sure those are the same people with the high credit card debt and everything else. If they have to be forced to start paying their student loans, and I know you and I have seen different stats that I think you saw 250, an average of 250 like a month. I saw 350 to 400. Yeah, let's just call it 300, right?
Yeah.
That's an extra $300 a month that they're not just freely spending into the economy. That's going now to pay down a loan. And now what happens if they don't have that $300? That means something else gets sacrificed.
Yeah. Yeah. Something gets sacrificed, or people start filing bankruptcies, and all that starts to fold out into the real estate market and everything else. So I think there's a lot on the table now that it's a reckoning that I think a lot of people that have not been paying that 18%, I think they realistically thought that they'd never have to pay ever again. And they've gotten used to not paying now.
Not only that, but to shift gears like to the commercial property market, where they were talking about the vacancies being really high, which means the revenues have pulled back for many of these commercial property owners. Simon is one of the largest ones out there. And one of the big things is they were talking about how much of their loans are coming due in the next 2 to 4 years.
Yep.
It's in the hundreds of billions of dollars. That what are they going to do? Walk away from their properties and hand it over to the bank? Bank doesn't want the property.
Yeah.
So what are they going to do? They're going to just maybe sell it to Amazon for more distribution centers.
Yeah, no kidding. Or I thought the funniest thing is, well, we'll just convert we'll convert all these commercial properties in New York to apartments. Okay, you've got
going to buy them. Who can afford them?
Who's gonna rent them? There's 500,000 people that moved out of New York in the last 2.5 years. You've got a negative 500,000 that have moved out of the state. Okay, who's going to rent these apartments apparently in New York City? Are you going to use them for the homeless people or the people that are coming across the border? I guess that's the only solution at this point to
that's what
having
San Francisco the solution was. They're putting the homeless people into hotels.
Yeah. Yeah. So we'll take these offices and turn them into hotels because we don't have any hotel space in the town anymore. Yeah, it's interesting. And you know me, I'm always a big fan of the leading economic indicators.
Yeah.
Let me show you
a couple charts.
Let me show you this chart on the LEI. So this is May LEI. So it was reported in late June. Once again, mirroring what you were showing on a bunch of your charts. We're at one of the lowest points we've been in a long time. I think the only thing that's really holding us there is GDP is just amazingly resilient.
That's the consumer.
Yeah. And so GDP is still hanging in there. So you typically don't see a recession until GDP goes negative. Now we're still on that trend, but we're still a ways away from hitting that zero line and going below, which would indicate that we're truly in a recession. Now, mid-June or next couple of weeks, we'll get the June numbers and we'll see where we're at. I think we've seen GDP. It actually kind of had a little bit of a spike up here recently.
Yeah.
So until we see something different, we're certainly indicating that. And I think the biggest things in here, when you started to look at, this was a massive LEI change down 4.3. Some of the big stuff in there, consumer expectations for business conditions, index of new orders was down pretty significantly. Interest rate spread, that 10-year T-bond, less Fed funds, leading credit index. So a lot of these things are starting to come down. And I think consumer expectations of business conditions being down as much as they are, that's intriguing to me because the consumer keeps spending, but they're thinking business conditions are much worse.
Is that LEI change? Is that month over month or year over year?
This is month over month.
Okay.
Yeah. Or no, this is year over year. I'm sorry. Yeah, year over year.
Now, the interesting thing about the GDP, because I think it's an old, antiquated way of measuring a recession, because two quarters of negative growth. So if we're at 5% and all of a sudden we go to 4.5 to 4% GDP, we're in a recession. Yeah. Come on, 4% GDP. You know what I'm trying to say, but take it a step further. Many times they say that the market will bottom before 2 straight quarters of negative GDP growth. So by the time the GDP goes negative for 2 straight quarters, the market is typically bottom. And I think we'll probably see that, if not Q4, Q1, but by then I think the bottom would have already come out of the market in that time frame.
We'll have to see. We've just continued to run on the markets at this point. So I don't know what's going to stop them. I think we're in a kind of a weird generational shift.
Actually, do me a favor, Jeff, stay on this chart for 1 second. If you notice, the LEI goes negative before the recession.
Oh, yeah. Yeah. And it typically, but it doesn't, if you look at it, LEI goes negative and pretty much significantly goes negative. And then the recession is indicated typically by somewhere in here, the GDP goes negative or at least touches the 0% line. We're getting there. And certainly the LEI side of it, we're one of the lowest points since 2000. We're the third lowest point since 2000, still going at this point. Yeah. I still believe that it's out there. I don't know if it's a soft landing. I don't know if it's a short recession like we had during COVID, where then we spiked back up. But we've just been on a continual downward spiral since 2021. And I don't really see it turning around anytime soon, because you're just now starting to really see some of this stuff go significantly negative.
Yeah. Actually, the PMI, which measures the manufacturing,
Yeah.
was in the low 40s.
Yeah.
Typically 50 and above is supposedly positive. And
Mhm.
I believe that they were looking for like a 48, 49 number, and I think it came in around 43 or 44. So
Yeah.
that's just telling you manufacturing is slowing down also.
Manufacturing. And like I said, then you see it indicated here in the ISM, new orders index down really significantly. It's down almost the
The
worst
ISM, I'm
level.
sorry, not the PMI, the ISM.
Yeah.
That's what I meant. Yep.
Yeah. So yeah, significantly down. So that's just saying, okay, a lot of those companies are sitting out there and saying, hey, I'm not making any major investments right now. We're just going to wait and see. And that's rolling down through the manufacturing sector. That said, if we look at the fear and greed index, we still remain at extreme greed. The last time we were at extreme fear was over a year ago. We were down in the 22s, which was one of the lowest times we'd seen in many years.
And that's where they were raising the rates 50 and 75 basis points like six times in a row.
Yeah, absolutely. Yeah. And that was at that very point where starting in March, it just started to really get hammered hard. Yeah. And we went into that extreme fear, but it's been extreme greed. Once again, led by just a few stocks here and there, a lot of strength in the markets. This, I think, is one of the more heartening things is the stock price breadth. We're starting to see the breadth being expanded in the market a little bit, but once again, it's still being led by those 8 or so stocks that are just like a ship going up.
Don't forget too, a lot of that is company retirement money. It's got to go somewhere. And in the top funds, whether it's a growth or a balanced or whatever, those top 8 stocks are in every single one of those funds. So the money is constantly flowing there.
Yeah, and so many people investing in the S&P 500 through indexes and everything else, all that money just plowing in, it's got to go someplace, and it's just getting continually poured into those stocks. And I think the other reality, a lot of people, we've got the largest generation in history ever moving into retirement, 10,000 people a day. And the reality is they have to stay in the stock market because the yields are still better.
Absolutely. And you're not even talking about even on regular equities. You have other alternatives in there between treasuries, which are not really tax advantaged, right? But then you have preferred stocks, you have other types of stocks that are yielding high and selling at a discount. Yeah. So you're going to make money on both sides. If you have a little bit of a longer term horizon, 2 to 3, 3 to 5 years on a lot of those to truly work out, to earn 5 to 6%, why wouldn't you?
Yeah. Absolutely. And if we believe the Fed, which I'm inclined to say I do, rates are going to stay high for a lot longer than you think. So why would you not take advantage of a riskless rate of return? Certainly, why would you have cash sitting around at point nothing when you could have money shifted into treasury, even short-term treasuries making 4.9 at this point?
And I think if I just saw it this morning, the 2-year hit 5%.
Okay.
So and they say, and I had heard from some people that I do respect listening to, right? Because I'm not the smartest guy in the room, but I try and listen to as many people as possible. They said a 2-year note at 5% is typically the straw that'll break the camel's back, as far as now things are adjusted where the banks are going to have a tougher time lending and making money. Less people will want to borrow. 5% is typically that straw.
That magic point.
Yep. I don't know. We'll have to see. It did hit it not too long ago, but didn't stay there. So if it continues to rise and sustain, again, I think everything that we've been talking about for the last few months will eventually kind of pan out here past Labor Day.
For my own internal portfolio strategies this week, I rebalanced all portfolios for the end of the quarter, and any excess cash, we just moved into 2-year treasuries at this point. Yeah. Because they were all sitting, I think I was buying at 494 or whatever. Why would we not do that? Why would we have cash?
Actually, forget about 2 year. You could go into a 6 month
Yeah.
for 5.2 or 5.3 or whatever it is and not tie up the money as long. Obviously, it's great if you have somebody in retirement to know, hey, for 2 years, I'm going to get 5%.
Yep.
Risk free. It does make sense. But if that's the case, more money is going to flow into that market. And meanwhile, at the same time, talking out the other side of their mouth, the Fed is trying to shrink the balance sheet.
Yeah.
So if they're trying to shrink the balance sheet, that's only going to push yields up.
Yeah. It's
in the short term, pre-retirees and retirees are going to feel pretty good in the next few years. They're not going to grow their portfolio exponentially, but certainly they're going to get the income and the asset protection that they desire.
Where they don't have to take a ton of risk at this point to get 5-6%. It's not that hard to do when you've got rates as high as they are. And like I said, I don't foresee inflation going down below that 4% rate for a long time at this point. I don't think there's much else that the Fed can do on their side to pull rates or pull inflation down. It's going to have to be from the fiscal side, and the fiscal side, Washington just wants to spend money no matter what.
They want to get reelected.
Yeah. Yeah. It's how you keep getting elected every time is by, okay, I think your idea is stupid of what you're spending money on, but we should spend money on my stupid idea instead. And it becomes this never ending spending spree.
No, they got to help their constituents or nobody's going to vote for them. And I hate to say it, the average citizen out there is just about, they really don't care about fiscal responsibility with the government. They're concerned about themselves, their house, their community, and that's it.
Yeah.
What's going on in the rest of the US doesn't matter. I'm only concerned
about
what's going on here.
Well,
and I get that to a certain extent, but at some point you just got to realize, I understand you got to take care of yourself, but the recklessness and the absurdity of the spending on both sides is just ridiculous. And this whole debt ceiling thing is my last quick point. That's great. They cut spending in some areas. The borrowing is still going up. We're not doing anything to cut our debt in half. I honestly, Jeff, I was thinking about it, had a couple of good conversations with people that were in the government on the defense contractor side. And I'm like, how do you cut the debt in half? Because the money's already out there, right? It's already been spent. It's already in somebody else's coffers. How do you cut it in half? The only way to reduce the debt is to reduce the spending.
Yeah.
So if 2/3 of our spending is in entitlements and in defense, what are we going to do there? How are we going to be able to cut it in half?
I guess the good thing, that's going to be eclipsed in the next few years by the amount of these higher rate bonds that are out there. So that defense spending and entitlement spending will be far eclipsed by what we're paying on our debt. So we've charged our credit cards up, much like the rest of the economy. We've charged our credit cards up, and now we're going to be paying much higher rates on our credit cards as a country at this point.
Yep. And we already talked about how that's at an all-time high.
Yeah.
Carry over credit card balances. At some point, when they're not paying their student loans and they can't afford their monthly payment, even the interest on that payment, guess what? The bankruptcies are going to skyrocket. But at the end of the day, what they don't realize is that the credit card debt and their student loan debt does not get discharged in a bankruptcy. They're still on the hook for it.
Yeah. Yeah. It sticks around with you forever like luggage.
Absolutely. Absolutely.
Yeah.
I'll have to say it should be interesting as the summer goes on, the volume in the market goes down, see how much it gets pushed around. I think I saw 60 to 65% chance at this point of a rate hike in July. The next one after July is in September.
Yeah.
Which it's a long time frame there, and a lot's going to happen between July and September.
Well, yeah, and you figure the student loan stuff is going to hit somewhere in August. I think it's like the 21st or something.
Okay, I thought it doesn't matter. At the end of whatever it is, I think their first payment is in September.
Yeah, it's August or September. Yeah, somewhere around there. So
yeah, but it ends in August.
Yeah, just perfect time for everybody to go back to school and everything else, and have to start paying on that. But I think it was shocking to me. I think you told me that earlier today, of the percentage of people still in their 50s and 60s that are paying on student loans at this point, which
It's
is
a smaller
insane.
percentage, but they're still out there.
Yeah.
So we'll have to see how it goes, but I can't wait to hear all these idiot pundits that have been saying no recession, soft landing, no landing. After what we see is probably what's going to happen here in the next 60 to 90 days between the student loan, the commercial property, and some of these other factors as they come to some type of a crescendo.
Yeah, absolutely. We'll be talking about it for sure. Thanks, folks, for staying with us. Make sure that if you have the opportunity, give us a comments of things that you want to hear. We've gotten some wonderful comments, and I think one of these times down the road, we'll call you guys out and say thank you for your comments, because we really appreciate it. It's helped to make us a better show as we've gone along here, and certainly love to share everything we can with you. So make sure that if you have any questions, share them with us in the comments. Certainly give us a, if you can, and make sure you subscribe to the channel so that you catch these every time they come out. Thanks a lot, and we will see you guys back here next week.